Whether you are new to trading or have been around the block and traded for years, you have probably heard traders talk about capital preservation. It sounds simple, but why do traders talk about it, and what does it really mean? When traders talk about capital preservation, they're referring to the idea of protecting the money they already have before making more. In the same way a business will focus on its core strategy before adding more, capital preservation is, in my opinion, the foundation of building long-term success in the markets. In very simple terms, if you lose your capital, you're out of the game. Capital preservation is about survival, not just profits. So, how can traders put this philosophy into practice? First, it starts with risk management. That means defining a maximum risk per trade, per day, or per week, and sticking to it. For many traders, this might mean risking no more than 1 to 2% of their total account on a single position. This helps ensure that one bad trade, or even a string of them, doesn't wipe out the account and the trader is able to come back the next session. After all, as far as we know, the markets are not going to disappear tomorrow. Using stop loss orders, proper position sizing, auto liquidation functionality, and most importantly, discipline, are all key tools in this process. Keep in mind, of course, that stop losses are not always guaranteed. But capital preservation isn't just about how you manage trades. It also involves how you structure your account and what products you choose to trade. Margin plays a major role here. When you trade on margin, you're leveraging your account capital, which magnifies both gains and losses. High leverage can lead to faster profits, but it can also accelerate losses just as quickly. Traders focused on capital preservation often avoid using their full margin capacity. Instead, they leave room for market fluctuations and aim to avoid forced liquidations or margin calls. At EdgeClear, we do not believe in promoting ultra-low $500 margins on ES contracts, as they tend to encourage over-leverage. Instead, we start margins at approximately 25% of the initial margin exchange, and upon further review from our risk team, we may go as low as 10%, which is our absolute minimum. We feel this approach helps support the capital preservation mindset by encouraging more responsible trading behavior. That's where initial funding comes into play. Underfunding an account and trying to stretch it too far with larger positions increases the odds of a blowup. Starting with enough capital allows you to trade comfortably within your limits. At EdgeClear, our typical recommendation is to fund your account with at least the full initial margin requirement per contract you plan to trade, even if you're only trading intraday. In our opinion, this gives you a buffer, which may help absorb losses without triggering auto liquidation and creates a more stable foundation, aligning perfectly with the principle of capital preservation. Finally, there's the choice between trading minis versus micros. Micro contracts like the MES or MNQ allow traders to scale their exposure in a smaller increment. This makes it easier to manage risk and build consistency, especially with modest account sizes. On the other hand, mini contracts carry larger margin requirements and higher dollar risk per tick, which may not align well with the capital preservation approach for newer or smaller account traders. If you have any questions about the information mentioned, please feel free to contact your broker here at EdgeClear for further clarity. Thanks for watching. Feel free to like this video and subscribe for more. Happy trading.